Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Caitlin Cormier. One of the biggest stories in the news has been the way the drug Ozempic and others like it have taken the market by storm. Not only are they revolutionizing weight loss, but a growing body of research suggests they may lower the risk of heart attacks, stroke, Alzheimer's, and even some cancers. The success of these drugs could be just what the doctor ordered for the healthcare sector. This chart shows the performance of US healthcare stocks compared to the S&P 500. They've significantly underperformed the broader index over the past 5 years, delivering roughly half of the gains. But today's guest speaker argues technological innovation could be just one of the factors that gives healthcare stocks a shot in the arm. Here to share his thesis with us is Paul MacDonald, Chief Investment Officer at Harvest ETFs. He's also the lead portfolio manager of the Harvest Healthcare Leaders Income ETF. Paul, welcome to the show. Great to have you here with us.
It's great to be here, Caitlin. Thanks for having me.
I'll try not to have too many of those healthcare puns as we roll into today's session, but if they come up, you'll just have to bear with me.
It's healthy.
So first off, let's just hear a little bit more about you. So can you tell us about your experience in the investment industry and managing healthcare funds?
Sure. A bit of background. Originally from the East Coast, we were talking about before, and I've been in the investment industry now 20 plus years. I've been a portfolio manager for the past 15 plus years, and I've now been at Harvest coming into my 13th year. So at Harvest, we're a Canadian independent asset manager, and we have various sectoral-based investment funds. And so I oversee a team. I've got 6 in total on our investment team, and I'm also the lead manager and have been since 2016 on our Healthcare Leaders Income ETF. And so that's a large cap healthcare income-focused ETF and one of the larger healthcare ETFs in Canada.
All right, excellent. And just to shout out the East Coast, I'm located in the East Coast, so we always like to have that East Coast connection. So always good to speak with a fellow East Coaster. So in our chat today, we're mostly going to talk about US and global healthcare themes. Why do you think it's important for Canadian investors to consider gaining that kind of exposure to the global healthcare sector rather than just sticking close to home?
Well, there's a few reasons. The first one is the healthcare sector outside of Canada is massive. It's massive in Canada, but from an investment perspective, there's really very few ways to get exposure. And so when we think about the healthcare, I know most people immediately think, well, that's just the drug developers, but it's actually a massive sector. And yes, it does include pharmaceutical companies, biological companies, but it also includes companies like managed care, which again is an area that we don't really have in Canada, but they're the ones that effectively administer healthcare for government programs and for commercial programs in the United States. But also areas actually that have been performing quite well also recently, areas like medical devices and areas like tools and diagnostics companies. So when we think about healthcare, it's not just the drug development, which is what usually first come to mind. It is an absolutely massive sector. And so from a Canadian's perspective, and I see a chart just came up, this really highlights why we want to be looking outside of Canada. And Canada's home to some great companies. We often say some great oligopolies as well. However, in the healthcare space, there really isn't a whole lot of exposure here. And in fact, when we look at the S&P TSX, including the various marijuana and includes some real estate companies as well, and real estate operating companies, it's less than 1% of our domestic market. So when we think about this from a global perspective, healthcare is really 10 to 15% of the overall market. And, it benefits for some great structural long-term tailwinds that I'm sure we'll talk about. But from a Canadian's perspective, we really need to be looking outside of our borders to get exposure towards the sector and to some of those longer term themes.
Just because we're a large landmass doesn't mean we're a huge part of the economy as a whole. So absolutely, that completely makes sense. That there's lots out there to reverse, not just what's here in Canada. So some good perspectives there. Okay, let's dig into some details of the view that healthcare stocks could be poised to outperform in the years ahead. So this is kind of your view here. The Harvest team sees several short and long-term catalysts for top global healthcare companies. So can you take us through some of those key drivers that you feel could positively impact the performance of the health sector?
For sure. So there's a couple really structural long-term drivers that we would say, form our basis of why we want to have exposure to healthcare. And, I would argue many of these are permanent and non-cyclical. And so the first one is aging populations. And so we know all around the world, populations are getting older, particularly though in the developed world. So when we look at North America and Europe, the proportion of the population cohorts that are over 60 is increasing significantly. And by itself, one might look at that and say, okay, well, why does that matter from an investment perspective? Well, it's because as we age, the amount that we spend on our healthcare needs increases, but not just increases a bit, it actually increases exponentially. And so you kind of have two waves happening where you have a large cohort of the population that's getting older, and that population cohort also spends exponentially more on healthcare needs. So when we look at US data, for example, and I see a chart that you just pulled up, you can really see those. And the US has often amongst the best data when we look at these bigger macro themes. And so we can see that as we age, we spend significantly more. And so that is kind of number one, which would be, of the permanent and non-cyclical drivers is populations are aging. As we age, we spend exponentially more. The second, I would say, would be second and third are developing markets and technological innovation. And I'll talk about tech innovation in just a moment. When I think about developed markets, for example, we've done all kinds of interesting studies on the proportion of an increase in wealth in GDP, for example, that is expended on our healthcare needs. In developing nations, it's actually a disproportionate amount. And what that means is as we increase our wealth, we're spending more of that increase on healthcare, which intuitively makes sense. And for anybody that's gone to business school and remembers those hierarchy of needs where we need food, water, shelter, and then healthcare. So that spending does, and we see that does increase. And we can see that when we look at areas like China and India. And so that's another longer term thematic that we think is in place. And so aging populations, developing markets. And the third area is technological innovation. And I think it's fabulous. My watch tells me when to stand up, and it measures my heart rate. And that's one part of innovation, but that's not what I'm talking about. What I'm talking about is really some of the massive advancements that we've seen in drug development, biological drug development. And of course, when we think about innovations across medical devices, the scientists that are doing this development and this research in the background, the products that are coming out, it's absolutely amazing what they're able to do. But that's driving not just a longer term thematic, but also a shorter term, kind of inning 7 of a baseball game that is likely to go many innings of technological innovation. And that really is driving some of the positive shorter term, in addition to that longer term outlook that we have.
All right. Even like when I think of people with diabetes, like the way that that stuff has increased in that, in that area, just with the types of the way people, they can test their blood sugars and stuff, like using cell phones now instead of having to, anyway, I can understand that there are quite a lot of innovations, and that's just
For
one
sure.
small piece of the whole picture. So, okay, that's a bird's eye view of your thesis. So let's talk about some of the short-term catalysts. So the most obvious being the new Trump administration. So first off, how much of Trump's policy do you view as bluster versus genuine policy goals as it relates to healthcare?
So let's take a step back on Trump. And I know I'll try to keep my giggle a little low. I think when I look at kind of some of the discussions that are happening at kitchen tables and over dinner and drinks and in boardrooms as well, including meetings that we're having, there's a lot of heated emotion on some of these policies and things like tariffs. And, you only have to go to a hockey game to appreciate the emotional sort of energy that's going into this right now. So, if we kind of take a step back, there's two things that are going on. There are broad policy uncertainty, if you will, and in particular trade uncertainty. And we do measure that. We've got some pieces on our website that measure trade policy uncertainty. And then there's uncertainty associated with healthcare and healthcare policy. So starting with the bigger trade policy, that's something, unfortunately, when we look back at Trump's past presidency, and again, something that we can measure, the risk is likely to stay. And these types of movements in the market, and a tweet here or a tweet there, seems to be more pronounced, at least for now. And that was the case back, if those remember, 2016, 2017, and it did dissipate, but it came almost in ebbs and flows. And so I think we're going to have deal with a lot of those shot across the bows and some trade policy uncertainty. Within healthcare specifically, I remember the debate that Joe Biden and Donald Trump had, and Biden says, well, what are you going to do to fix the Affordable Care Act? And the answer was, well, when I come up with something better, we will. And that in short. And so the message there is that there's a lot of policy changes that are already being implemented. But when we think about healthcare policy in general, and I see you put up one of my favorite slides, that when we talk about healthcare, because it's super complicated. And this is a dated chart. This is going back a few years, but I like to share this, and I know you guys do too, that it just highlights all of the interwoven nature of healthcare delivery within the United States. And so not just the interwoven healthcare delivery, but all of the vested parties and agencies and individuals that are associated with that healthcare delivery. And what that has done is it does make some of the more draconian policy changes that are often feared from an investment perspective. It does make those very difficult to implement. And so that has been our experience. That's actually day over day. We have different analyst meetings out of the US, out of Washington, dealing with specialists that are integrated within healthcare policy. And we're measuring that, and from what we can see right now, it's very difficult to implement changes. Some are already in process. They take time. The Affordable Care Act through 2014 actually had some very positive benefits from a delivery standpoint, but it's absolutely, unfortunately, something that we're likely going to have to, similar to the trade policy, we will have to have this cloud come in and out as different tweets and different one-off policy proposals are proposed. Implementing those proposals has, in fact, proven very difficult, even under Trump when they had the presidency, the Senate, and the House, to implement some of those policies. So, again, from our perspective, we have to talk about it, but the implications from an investment perspective are likely more noisy than they are actual practical, fundamental issues for the sector.
Okay, talking about stopping and starting delays, Trump has started slapping some tariffs on goods from key trading partners, including Canada, Mexico, China, and Europe. So how much could this impact US and global healthcare providers?
So we see a little bit of an impact. So a lot of our companies, and in our fund, we've got 20 large cap healthcare companies. A lot of them have manufacturing globally. But the margin on their products tends to be very meaningful. So the cost of inputs tends to be relatively low. So the impact from tariffs in and of itself, no, that's excluding what those tariffs do to broader inflation, to currency movements, and there's other and general market sentiment. But from a fundamental perspective, generally tariffs are relatively low risk, I think, for most of the healthcare companies, and some that are more predominantly just domestic focused, including areas like managed care. The one area, some of the tools and diagnostics companies do have some exposure with China, also some manufacturing overseas, and import some of their goods. They tend to have slightly lower margin and maybe a little bit more impacted from some inflationary pressures. But again, these are proposals. Let's see what actually gets implemented. And for now, we're less concerned about broader tariff, broader trade policy for healthcare, as much as we are, let's start to look at some of the proposed policies under RFK, under things with like National Institute of Health budgets. We're looking a little bit more granular on those areas to say what's the real fundamental impact. From our perspective, the tariffs, it generates a lot of heated emotion. A lot of industries are going to be meaningfully impacted, but healthcare is likely to be one of the few that are relatively insulated.
Okay, that seems like relatively good news. So one less thing to kind of get too panicky or emotional about. But you did bring up part of my next question. So my next question is Trump's pick to lead the Department of Health and Human Services, Robert F. Kennedy Jr., has said that he wants to eliminate certain parts of the U.S. Food and Drug Administration, which regulates, of course, food and drug safety. So Trump also seems to be pushing for sort of wider spread deregulation of industries. So what sort of impact could that have on the U.S. healthcare sector?
Great question. So let's isolate deregulation and then talk about RFK specifically. So deregulation likely to be generally positive for markets in general. So areas I don't cover, like U.S. financials, for example, tend to benefit. Likely to see, and there's been some other events that have resulted in more likely to see M&A occur within healthcare, so less sort of conflicts, if you will, or trade. It escapes me right now, but basically trade commissions saying, no, you can't do that acquisition. So we may see a little bit more of that. And so with the FDA, there's likely some expectations that we'll see more approvals and perhaps faster approvals. It's been really backlogged and jammed for approvals. So that could open up the playing field a little bit, and we could see a little bit more competition. It's not really something that's been a focus, though, for us or for industry, other than to say, hey, let's keep an eye on how that shakes out. So that's kind of bigger, broader deregulation. So generally, actually, some potential positives, and it's not, I wouldn't put a thesis around that, but you may get some positives from some deregulation. But RFK certainly has some distinct views on certain areas within healthcare and healthcare delivery. And so from what we can see, the bulk of sort of, some of his more draconian policy proposals focus in on two areas. One is on the food side, and that has less impact to us. So different things like additives, food additives, and having, perhaps food stamps not being allowed to, buy soda pop and differing things like that versus some of it, though, and his views on vaccines tend to be fairly controversial, to say the least. And so prior to, his approval actually earlier today to lead HHS, he actually had to go through the whole vetting process. And in that vetting process, there was a lot of questions about his views on vaccines, where he is effectively an anti-vax promoter, if you will, in some regards. He's had to walk that back, but absolutely, this would be one sliver within healthcare that we have to keep a really close eye on, which is, what are the fundamental potential implications for vaccine manufacturers? So I believe it was Senator Cassidy, who's a doctor, prior to saying, yes, I'll vote in favor, did put in some fairly stringent, we have to, meet a certain frequency, and we have to have these types of things happen before any real policies are put in on vaccines. But that's one person. So he's in. So we do have to keep an eye on that. So very much an area that we focus in on and say, okay, do you know how much exposure do we have to that vaccine market? You know, I actually find it quite ironic if you read about where he makes his money from, you know, basically referral fees to law firms to sue vaccine manufacturers. It's almost a bit surreal. That is unfortunately the system. An area that we do have to focus in is on that. And then the second area is, you know, more recently, what are the implications for academia and government-run institutions? From a financial perspective, I'm looking at it, well, they're big buyers of lab equipment and reagents. So how does it impact my companies that are selling into them with recent proposals for the National Institute of Health budget cuts? And so the initial response is stocks down. However, when we look and see, you know, proposals for budget cuts in 2018, I believe it was, that's an area where we had 22%, Trump wanted 22% reduction, and we got a 9% increase in budgets. So, you know, there's a lot of shot across the bows and seeing what actually gets implemented. Those are kind of two of the main areas that we're really focused in on from an investment perspective. So our vaccine exposure, and it doesn't mean we don't want to have exposure there in our fund diversified, but it does mean we have to keep our pencil sharp on the implications. And then, you know, from tools diagnostics, you know, what's the implications for budget cuts within NIH, and is that something that's likely to happen as proposed? So those are a few things that we're watching. So yes, we have to keep an eye on these. The actual outcomes, they are usually shoot first, question later, and so we see volatility in a lot of these names. And so for people like us, we're always looking at, okay, what are the probabilities? What's the realistic outcome here, and is that actually an opportunity to pick up some of these names that are perhaps sold off on more emotional trading?
I would think that idea of these really kind of polarizing topics in general, they cause, you know, debate, so they probably are going to cause uncertainty, you know, in the market as well, right? Anytime we have something that's people are really passionate on one side and the other, that usually tends to create a bit of chaos, right?
It does, and so quite often we look at volatility in two different ways, and I don't want to overcomplicate our conversation, but one way is what's actually happening on the day over day. So did the stock sell off today or did it go up? And, you know, that's one measure of volatility. And the other way that we measure volatility is what's called implied volatility. And so that's something that kind of tells us what the market's expectation is going to be going forward. And so that's how, again, I don't want to overcomplicate, but we use our option strategy. So as volatility actually goes up, that's where we generate, you know, we tend to benefit from some of that. Yeah, that's correct. Exactly. So,
yeah. Yep. Yeah, gotcha. For those option traders out there would understand that for sure. Okay, in your opinion, does it make sense for investors to try and invest in sectors that are expected to benefit from Trump's policies?
That's a great question. So I've got, as I mentioned, I've got 6 people on my team. I think one of the biggest sort of, without giving advice, one of the biggest things I can say today is there's no such thing as a free lunch. And as my colleague says, except for diversification. And so I think in this environment, I think a couple things. One, absolutely, there's some areas that may benefit from some deregulation. I mentioned financials would be an area, but other areas that benefit from things like a recovering economy. You know, as much as we hate to hear, oh, they're reshoring all of their manufacturing to the U.S. and, you know, well, that tends to benefit companies that are in the industrials that are reshoring that manufacturing. And so, you know, it's something like the industrials seem to have some tailwinds. Now, that doesn't mean that, you know, if that doesn't happen or if, you know, policies impact them, yes, you could see some pressure. So I wouldn't base a thesis on that, but having exposure to areas like that, I think in this environment, it makes a lot of sense. But then having some of the more defensive characteristics like what we see in areas like healthcare and even in some of the global utilities that tend to, you know, if we do get a little bit more uncertainty and we see these policies actually enacted on the tariff side, you know, you could see more volatility. So, you know, we see, you know, even just a few weeks ago when we had the tech sector pull back, healthcare was up 2% on those days. So we can see that happening with shots across the bow. So having diversity and having that exposure to perhaps some of the more defensive areas. In addition, I think you still have to have the areas that may benefit, but also areas like tech, but having some defensive areas, and healthcare does fit in within that part of that thesis as well.
Tale as old as time, just go back to diversification, right? Investing based on your goals.
Yeah.
Okay, let's switch gears. We'll go into some of the more longer term drivers. So you had mentioned aging demographics around the world and how that will kind of increase demand for the healthcare services. But that is a trend that we've known about for quite a while. So what do you feel that the market isn't appreciating that could drive an outperformance in the healthcare sector?
Well, I think a couple of things when we think about what's driven the market over, call it, the past 5 years, X for 2022, it's really been styles that, growth and momentum in particular, but large cap growth, large cap momentum. And part of the reason for that too, when we look at earnings across the market, tech was ripping in through 2023. We had 50% year over year earnings growth, while the rest of the market was relatively muted. And in fact, X the big seven, we had negative earnings growth expected across the 493 names in the S&P 500, going back about a year and a bit. And so what we've seen though is as the economy in the U.S. has started to turn around, we've actually got some that's flowing through when we hear people saying, oh, the breadth of the markets, we got other sectors benefiting. Well, one of the reasons why those other sectors are starting to benefit is because the fundamental earnings are improving. And so when I kind of think about that longer term, absolutely, that longer term thematic is very much in place. We've got a few more clouds, I think, than most would have expected, just with some of these more draconian trade policies, and that filters through to general policy sentiment risks. And I think that has caused areas like healthcare to pull back. But underneath the surface, the fundamentals remain very much intact, both those longer term thematics we talked about, but the shorter term. And we can see that with our earnings growth expectations across both the market, which we're seeing that breadth expand. So it's not just the big tech names, which have great growth, but as other areas of the market are benefiting. And healthcare is absolutely a benefactor of that breadth of expansion. And so I see you have our earnings growth expectations. I will say a little bit skewed. There's a couple of the larger names in there that really have big growth. Talked a little bit at the start about the obesity drugs, and that has skewed a little bit of the earnings growth up. But in general, you've got an area that's got good valuations, good growth forecasts. That healthcare is typically what we call a superior good. So when markets are really running hot, and people still need their healthcare, and equivalently in recessions, you've got that defensive characteristics where we have some visibility, if you will, into the demand profile, and where people still need their healthcare. And so when we look at valuations relative to the market, I see put this chart up. This is I don't want to get into all the specifics, but the range of earnings valuations based on forward earnings expectations relative to the market. So you can see that historically healthcare is traded at a -5 to a +5 multiple compared to the market. And today, the little circle that you can see on the far right-hand side, it's trading at a discount. Just because you have inexpensive valuations isn't the catalyst in and of itself. But when I put that in with, hey, do you know what, we've got some real positive technological innovation happening, big results coming out later this year, perhaps some shot across the bow about maybe some time to have a little bit of defense. When everybody's on one side of the boat, they can move over very quickly. And so from our perspective, you put that all into the washing machine, and I think healthcare looks pretty good as we look out kind of through 2025 into 2026.
All right. You talked a little bit about Ozempic. You just kind of mentioned it a moment ago. So one of the major developments in the healthcare industry is the weight loss drug Ozempic. So why do you see this as a key driver of opportunity for major healthcare companies over the long term?
Loaded question. So look, Ozempic, or the GLP-1 drug class as it's been known, it's truly fascinating what's going on. And so, for those that don't know, these were diabetes drugs that turns out you lose weight on these particular drugs. And so now we're seeing some of them being actually approved, like a Wegovy, specifically for people that are obese. Now, in and of itself, one might say, well, that's just going to be everybody in Hollywood taking, I'm going from size 4 to 3, or whatever it might be. But that's not the case. So what this really comes down to, it was about 18 or so months ago, there was some key trials that came out that measured, yes, we're measuring weight loss, but what we're really wanting to find out is what does that do for other potential indications? And so we had very meaningful, in a specific cohort, very meaningful reduction in major cardiac events. So things like heart attacks and strokes. So for an at-risk population who wants to take this, well, I think anybody that can take it would want to have 25% reduction in those, and up to anyway 25% would want to have that, or at least talk to their doctor about it. And so that, to us, really, that's when the light really went on from an investment perspective. For clarity, and I see you have some forecasts that we've accessed on more consensus numbers. This is looking at what the expectations are for this drug class. It's a couple months old. We're up at about basically $100 billion of drug sales. So again, this isn't because we're just losing weight. It's because of these other benefits that we're starting to see. And when I say other benefits, there's 40 ongoing phase 2 or phase 3 trials that are assessing its implications for other indications. And so we had one a few months ago with 55% reductions. I think that's the number on sleep apnea events. We've got, what are the implications for various types of pain? And so the list goes on potential other areas that these drugs may actually reduce indications. So why does that matter systemically? Well, if you can reduce the costs of these other areas, that's a very main. And why would a payer, whether it be government or commercial, pay for this? Well, if you're going to have lower costs from all these other areas, then that absolutely makes sense to cover. So you mentioned Wegovy, Ozempic. Ozempic, Wegovy. I know we don't talk a lot about specific names, but I would say, that's one company, which would be Novo Nordisk, and a lot of people are familiar with that. The other company where we haven't heard a whole lot about per se in Canada, companies drugs like Zepbound and Mounjaro, made by Eli Lilly, it really hasn't hit here, I think, as much, just because they've had some supply constraints, but their efficacy is actually very, very good. And so when we think about, this being a potential for $100 billion market, that's kind of where we're at today, not including some of the really, really exciting innovation that's happening, in various combinations of these drugs. So to me, this is a drug class that it's probably the most exciting we've ever seen in the past 12 years, that just really is going to be, systematic or systemic. And so challenges that we're faced with are, how do you get this into a global market? There's different types of delivery mechanisms, different types of delivery frequencies. What's the efficacy? And of course, who wants part of a $100 billion market? Well, everybody. So you've got a lot of competition. So we have to be cognizant of that when you're looking at these from an investment perspective.
Now, you talk so much about, it's amazing to kind of see the trickle down, where you start with one purpose and then it goes into so many other. Have there been other drugs, like you said, 12 years? Were there drugs before that have had the same impact, or is this kind of, one of a kind in that way, or the most unique of that type of drug in your experience?
Look, in this class, absolutely. But I kind of remember, well, there's a bunch of different areas that really have changed lives meaningfully. And so the first one I remember coming back, listening to the head of research, it would be, I want to say back in 2016, listening to that research from a company called Regeneron on their Dupixent drug. And so this particular drug they were talking about, they showed somebody that could not shower because they had this such severe atopic dermatitis before and after the drug. And it entirely changed their lives. but it stuck with me with that particular innovation was, the head of research said, look, the light bulb just went on. We're seeing how the applications of this from an atopic dermatitis are applicable to things like COPD, severe asthma, other allergic issues. So that one in particular was really exciting. And I would say in through the 2017, 2018 period, innovations in immunotherapies. We're talking a lot like today, what we were back then, about drugs like Keytruda and Opdivo for Merck and Bristol Myers, respectively. So absolutely on the drug development side, in the past decade, past 20 years, there's been very meaningful innovation. But this one, I would say, is definitely, and with what we see coming down the pipeline in particular, for potential, global access, versus, higher cost regional specialty delivery, having global access, that's something we may get more information about later this year. That's a game changer. And so not quite anything like what we've seen, I don't think, in the past 20 years.
All right. It's exciting stuff. It'll be exciting to see how this innovation continues. Speaking of technology, AI is everywhere in the news, given how quickly it is improving. What sort of impact do you see AI having on the healthcare sector and your investment thesis?
So, big believer in AI. I gave myself my own podcast the other day just by uploading a presentation, and all of a sudden there was 3 people having a conversation about it, and it's truly fascinating what's happening. That's less applicable to reality than I think where we're at today. And so when I think about AI within healthcare, unfortunately, there's this vision, I think, from a lot of people that it's AI, it's going to cure everything, and that's not what we've seen from a practicality perspective. So what we've seen is AI, and a lot of M&A happening within AI from healthcare companies. So when we think about managed care companies, in particular, a company like United Health, which again, we don't really have a lot of similar type of comparisons in Canada, but they're the ones that, as I said, they're more like administrators of healthcare. They're, facilitate the different types of formularies, make sure the pharmacy gets paid, the doctors get paid, who can you go see, that type of thing. So we see a lot of interest from that side. So we can see that maybe from a scheduling perspective, physician efficiency, from a practical, where is it seen in healthcare? I think some of the diagnostic companies, Agilent just made actually a large acquisition in Canada over in the East Coast of a manufacturing facility. There are tools and diagnostics manufacturers. So they made an acquisition of a software that will model out various types of blockages within arteries using AI. So seeing AI being used on the diagnostics and more interest on the diagnostic side, but in the therapeutics and R&D, from the people that we talk to and the analysts that we deal with, we haven't seen nearly as much as one would think. Where we're seeing it being used are things like trial design, making cohorts of the population perhaps more efficient for different types of trial design, but really not that sort of panacea. I think that a lot of people are like, oh, it's going to find cures like this immediately for everything. Super exciting though, big dollars being invested by our large cap companies that we have and across the spectrum, but really only practicality that we're really seeing hitting market more is in the diagnostic side.
All right, so it's part of the thesis, but not the whole story when it comes to technology. What other technological innovations do you see supporting the case for healthcare stocks?
So a couple innovations, I would say, on the medical device side. And so the first one, I think, is robotic assisted surgery. And it is just absolutely fantastic, to see the type of growth that we're seeing there. And I think we have a chart even that highlights, basically a doubling of this market over the next, call it 3 to 4 years. And so we're hearing more and more about this in the Canadian market. And so, no, we're not the first ones. We're not the first ones to go, oh, cool, robotic assisted surgery. And for clarity, this is an Omnitron, doing the surgery. This is a tool for the surgeon, and why somebody might like to use this is because readmission rates are lower. The effectiveness is can be sharper, and therefore, from a financial perspective, you get a better patient outcome. In addition to that financial side from the buyer. So, of course, like I said, we're not the first ones to discover this. So we have seen a lot of the stocks actually start to participate in this over the past couple of years. So robotic assisted surgery, super fascinating what's happening there. And within our 20 stocks, we do have various types of companies that are either pure plays or have it within their business. So that would be one area. Some of the ablation that we've seen, and again, I won't get in for AFib. That's really cool. That's front end of the curve, just starting to happen. So as opposed to perhaps freezing cells within the heart, they're using more of a pulse, and it becomes much more efficient and less damaging to some of the other cells. So again, without going too far down the veins, it's super fascinating across medical devices, seeing some really cool innovation. You mentioned earlier continuous glucose monitoring. That's also, in the past, call it 5 years, has just even more and more efficient. So super exciting. It's not just on the pharmaceutical and biopharmaceutical, but on the devices side, and then, as I just mentioned before, on the diagnostic side as well. Some really cool, fascinating innovation that these scientists are coming up with.
All right, exciting stuff. It's like the future is scary but exciting at the same time.
Some of it is Caitlin, is truly surreal to see. Wow, they can do that, and it is, and that's not only can they do that, they can make it more and more efficient. So yeah, I agree. It's not just about the financial side. This is, we talked about it with Dupixent, but this is changing people's lives and for the better.
Yeah, amazing. Okay, on the investment side, let's kind of stick back there. We talked a little bit about, you mentioned kind of diversification a little bit earlier about it, the free lunch comment, but so one way that individuals can diversify is by looking at something like an ETF versus kind of looking at individual stocks. So what are some of the criteria that you feel like investors could look at when they're researching healthcare ETFs?
Great question. And look, so the advice that I give advisors and individuals is diversity is really key. That's for any type of investment, but within healthcare, I'm a big believer that it's very, very important. And the reason for that is that the science can change on one name very quickly in favor of another. Pardon me. And so one of the things I would say is make sure that when you're looking at a fund, perhaps somebody wants to have multiple different sectors within healthcare and try to pick those themselves. But I would say having diversity across the subsectors would be number one. If you're looking at healthcare investments, and for a couple of reasons. One is, as I mentioned, if one looks at the various robotic assisted surgery companies, they're hitting, and some of the medical device companies, they're hitting 52-week new highs every week comparatively to some of the pharmaceuticals that are caught up in some of the tailwinds. That can change very quickly. And so having that subsector diversity, but then also peeling, and I know within our funds, we peel back the layers to say, where are we exposed within that portfolio to various indications, whether it's, on the medical device side, do I have, a full spectrum of investments that are across multiple different types of treatments for medical devices? So do I have things in orthopedics? Do I have, cardiovascular, et cetera? And so having not just the subsector diversity, but peeling back those sectors and saying, hey, do you know what, where am I going to be exposed to each one of these particular subsectors? So I think that would be my first point, would be make sure if you are looking, either do it yourself and pick some various subsector ETFs, but having that diversity is really, really important across the subsectors and even within those subsectors. That would be the starting point for me.
All right. Before we continue, I do have a quick question for our viewers. Are you enjoying the show so far? Then make sure to subscribe to TD Direct Investing's YouTube channel. And if there is a topic that you'd like to learn more about, then let us know in the comments. Plus, follow us on Instagram at TD_direct investing to get a sneak peek at upcoming shows and a ton of other content designed to help you build your investment knowledge. Okay, we've heard a lot of interesting perspectives on our program in the past. So I want to bounce an idea off you to see if you agree or disagree and why. So we're going to show a clip. It's an idea from Winton from ARK Investments. So he sees AI radically shaking up the healthcare market in the years ahead.
We think that even the models today will become 100 to 1,000 times more powerful within the next 3 years, given how quickly AI is advancing. And if you look across the entire economy, the place where the most data lies, and probably the most misunderstood data, is in the health sector. There's a huge opportunity in taking all of this data generated by tools, applying modern AI to it, to actually turbocharge the speed at which better diagnostics and better treatments are both developed and delivered to market, ultimately yielding cures for rare and even kind of complex and widespread diseases.
So, Paul, earlier in our chat, you suggested that AI isn't making the impact in healthcare that it is in other sectors. So, how realistic do you think this optimistic longer term forecast is, where AI will lead to drug development breakthroughs and help cure all sorts of diseases?
So, look, I'm a believer long term for sure like AI is going to have a dramatic impact from a fundamental perspective. And I'm familiar, I think, with some of the genomics and various other types of areas that yeah, your previous guest was looking at. From what we're seeing, though, in kind of the short to medium term, it really hasn't, and absolutely on the tools and diagnostic side that they was referring, I would absolutely echo that is an area that is ripe. And so we are starting to see that. So I think that's one area that we do like AI more in the short to medium term. And absolutely the promise of AI, is absolutely massive over the longer term. What we're seeing right now, though, is the practicality is much more focused in very specific areas. But I would say, if I kind of take a step back on that, one of the things that, in addition to the AI, that I would say is just as technology has advanced so significantly, even in the past, call it decade, I would say that the propensity to have personalized and much more personalized medicine and treatments and diagnostics is absolutely going to continue to be the case. And I think AI will have a role in that. And so from our perspective, areas that benefit from that, like tools and the diagnostics companies that are making these really innovative diagnostics tools and various types of reagents that are associated with it, with the testing, those are an area, that's another longer term benefit. Again, shorter term, not as pronounced as perhaps the excitement and the feel might be, but longer term, absolutely, and specific areas and much more personalized diagnostics and treatments. I absolutely think that's going to be the case as we look out over, call it, the next 10 to 15 years.
All right, there we go. And just a quick reminder to our audience, you can find the link to the episode we've referenced here in the resource section of the broadcast console. So make sure to check it out before you go. You can also find them in the Learning Center on Webroker and on TD's YouTube page. Okay, we have heard a lot about the investment thesis for the healthcare sector. So on that note, let's hop into Webroker to show our viewers how they can screen for healthcare ETFs. All right, to get to the screener tool under research, we're going to come under tools and click screeners. Once we get here, we're just going to click on the ETF tab and create custom screen. Once we get here, we are going to choose, in order to find these healthcare ETFs, we're going to click on fund category, add criteria, and here we're going to choose sector equity. So we do have to scroll a little ways because it is alphabetical. Next, we are going to choose equity style, click to add, And in this case, we are going to go with large cap value. So large market capitalization, value stocks. And finally, we are going to choose index funds, add to criteria, and we're going to choose no index funds. I'm also going to deselect mutual funds from the result just to get our ETFs. And so we filtered through all the ETFs available by these criteria. So we're going to view 13 matches. So these are the ETFs that come back as matches. Not every one is healthcare, but you can see that there certainly are some healthcare ETFs to go through here from some different companies. There are lots of tabs you can click through to see additional information about these ETFs side by side. If you, in looking through, find a few that you'd like to compare to one another, you can go ahead and just click the box on the left-hand side. I'm just going to click a couple here. And when you're ready, go ahead and select Compare. And this will show you a side-by-side comparison of these ETFs where you can compare all the different characteristics, including the profile information, any ratings information, performance side by side, holdings allocation that's available, and be able to really kind of do a true side-by-side comparison of these funds. There's also a performance chart that you're able to look at where you can kind of see them and their performance over the past whatever period of time you choose and really kind of get a good feeling for how these ETFs are performing against one another. All right, so that's a little bit of help for our audience if they want to do a little bit more research on those types of ETFs. So Paul, we're going to leave the interview portion of our conversation there, but we're not done yet. We're going to open the floor and take some questions from our viewers. Are you ready to hear what our audience wants to know more about?
Sure, that sounds great.
All right, sounds good. Let us start with our first question here, and it is from Stacy. So Stacy wants to know, do you have a view on the best and worst case for the US healthcare sector valuations over the next 12 months?
Oh, that's loaded. Without making any sort of advice, when I look at the valuations of the subsector trading at nearly 4x multiple, and again, I don't want to get too complicated, but you've got great valuations, you've got very good visibility. The growth momentum, large cap momentum trade still tends to be working. I still want to be there for some of that large cap tech. So the best case scenario, I think, is that we start to see some of these political clouds that have come in start to dissipate. I don't think it takes very much for multiples to expand, and by multiples expanding, that means stocks go up. So you get a little bit of a reprieve in some of that political cloud that's come in. I think that absolutely can be in a shorter period as well. And so a worst case scenario, I think, is that if we end up having much more gridlock, potentially, forced draconian policies, I think that's a very low risk. So, and again, Stacey, to your question, you can tell I'm focused a little bit more on the policies than I normally would be than fundamentals. And so if I can extend that out and say, hey, let's get through the midterms in the US over a 2-year period, and maybe it's in 3 weeks. I'm not sure that those clouds dissipate. But if I take a 2-year period, I absolutely think that we should be trading closer to a market like multiple like it has been in the past. That would be your best case. That's double-digit rates of return. And so worst case scenario, you end up in a recession, continued sort of political noise, and absolutely you could see double digits to the downside. I would point out to this, and I won't spend too much time, Caitlin, on this. There's some really big innovation coming. We talked about the GLP-1 drugs. There's some what we call oral trials. So if you think about, when I mentioned talking about getting these drugs out globally, right now you have to get a once weekly injection that needs refrigerated transport, et cetera. If these companies can come up with an oral, I think that would actually change the phase 3. We hopefully get data this year. That would change, I think, very quickly sentiment towards the sector. And right now, the why it's cheap is because sentiment's a bit out of favor. So you get that change quickly, you'll see a fairly big uptick in relatively short periods.
You keep using that term draconian. What
Yeah.
do you mean by that? Just to confirm, just to make sure that we're all on the same page.
So a draconian policy would be, you know, when quite often we would hear somebody like Bernie Sanders saying, "Hey, do you know what? We're gonna privatize all the drug manufacturing and privatize all of the hospitals and privatize the entire system." Those would be kind of the draconian, or those are the far draconian. But some of those more things, people are often shocked when I say, look at Medicare in the US, which is administered by these companies that we're talking about in managed care. They don't have the government per se administering as much as these managed care companies are. They're fully integrated and have bipartisan support. So when you peel back the layer, even just on the first layer, you can see those sort of policies that are more draconian. They catch headlines and catch the political lightning rod, so to speak. Generally really don't have any practicality associated with them.
Okay, just making sure that we're all on the same page. We have an interesting question here from Cameron. So Cameron wants to know, how would you compare your ETFs to other healthcare ETF providers, and what are your strengths? So interesting question, getting a more kind of specific onto the product that your company has, that you manage.
Yeah, and so if I just said favorably and we're better, I'm sure I'm not allowed to say that. But yeah, look, so what we do at Harvest, our healthcare ETF, which is HHL, comes in 3 different series, which is HHL.B, and which is unhedged, and then we have a US dollar, but they're all part of the same fund. It's about a $1.6 billion ETF, and we focus in on 20 large cap healthcare companies listed in North America, which means they're listed in the United States. And then we have a covered call strategy, and that covered call strategy, without getting into the weeds, effectively means that we generate cash flow every month for our investors by foregoing some of the upside on the stocks, and it's a third of the upside on the stocks. And the benefit of that is people that want to have exposure to these types of 20 companies and want to have some higher cash flow, that's what we do. And so I think for anybody looking at performance, you can look at performance at your leisure. And I think over, call it 1, 2, 3, 4, 5 years, we certainly stand up very strongly against the competitors. But I think when you look at our fund, 20 large cap healthcare stocks, for clarity, those 20 stocks, the market cap is 1.5 times the size of the entire S&P TSX. And so you do get that scale and diversity. There are options out there. And again, I usually tell people, if you're looking for healthcare and want to have that cash flow, that's where we come in.
All right. Okay. Very interesting. Not to put you on the spot there, but now it's helpful. We have a question here. We've talked a lot about the future innovations, technology, but this client, sorry, actually, I should double check with you. Are you okay to stay a little bit over? We're getting right to the end of today's session.
No problem at all.
Okay.
No problem at all. Thanks.
Okay, perfect. So this question is from Frank. So Frank wants to know, how does the healthcare sector look different in 10 years?
Oh, wow. That's a fabulous question. Thank you, Frank. I think, I mean, the whole sector itself, I think we'd have to start to peel it back by each one of the kind of the bigger categories that we talked about. I think the promise of AI that we talked about, that we're seeing right now in efficiencies. So I think, and again, I don't want to, be too forecasting, if you will, too much forecasting in a 10-year period. But I think the efficiencies can absolutely be had within that administrative side of healthcare delivery. I think that's going to be one area. If I put that over into, I'm going to call it the drugs, the devices, and the diagnostics, to me, what we were referring to before about that personalized medicine, I think it is going to be a much, much more personalized treatments, not just for, and that's already happening, but that's not just for, the drugs. And if my particular disease is associated with a particular tumor and I am of this particular blood type, therefore this is the treatment. I think that has that's already happening, but I think that becomes even more exponential if we look out over a 10-year period. And then I think about some of the innovations that perhaps on various types of genomics, and even things like CAR T treatments for specific cancers, which right now are very expensive, 450, 500,000 for treatments, because you need specialized facilities, you need specialized equipment, you need specialized nurses and doctors. Those types of innovations that have had very positive success, I think we're only going to build on those successes, and actually eventually we'll get cost structures down much more efficiently. So I'm actually really excited about the promise of that type of innovation. I think that's really exciting. And I love the fact that you're taking a 10-year view, because that kind of extends out beyond most of our time horizons, when we're thinking about it from an investment perspective. But I think that's a great way to look at it, because then I can compound that with, not only is that really cool on that side, but it comes straight back to that comment I made at the start about, we have a massive cohort of the population that is going to be basically in the highest spending periods of their lives, on healthcare needs. So you're going to have that in the background as a tailwind as well.
Okay, we'll have you back in 10 years and play this clip back to you and see what you think about your answer.
That's right. Perfect.
We have a question here. This one is from John. I think this is quite interesting. So the question is, how much does government legislation affect the healthcare sector as opposed to individual company fundamentals?
Yes, is the answer, because the proportion varies over time. Right now, I would say less about the legislation that's actually been enacted, as opposed to, I think, sentiment is a key driver. I think sentiment's a key driver for broader markets, but also within healthcare, the sentiment is very important. So what people are perceiving as what has been enacted, or perceived risks, which I guess would go down your line of, quote, government legislation. Once the legislation comes into effect, so when we think about, I was going to say before, about how Medicare is actually negotiating drug prices. So the U.S. government does negotiate drug prices with manufacturers. That's just happened in the past year or so. And so, but once we know that that's the case, then we can model that out and say, hey, do you know what? This is the growth, this is the value. But it's the uncertainty, I think, has more impact to valuations than, say, fundamentals at various times. And that ebbs and flows when we have these kind of clouds come in, like we're experiencing, I would think right now, where the political and policy risks are elevated across the system, and that I think has impacted. So the value of the companies, their earnings and fundamentals are still very strong. Just the price that people are willing to pay for that right now is less, and that's where you get what we call a compression in multiples. And so, great question. It ebbs and flows. Right now, the sentiment, I would say, is driving the valuations lower over the past, call it 6 months, versus necessarily the improving fundamentals within the companies.
Okay, very interesting. Very interesting. We have a question here from Vanessa. We've talked a lot about AI, and you've kind of given your position, but what would need to happen or need to change for AI to make more of an impact in healthcare?
Ooh, that's a great question. I suppose evolution and time will have to happen. I think systemically we'll have to get more comfortable. So, back to, I can remember it was John's question on, when we think about 10 years out, and the propensity perhaps to have a doctor on the other line of my chat GPT giving me a diagnosis, I think perhaps some societal comfort with that. And that will come, I think, over time. And it's early innings. And so I just think it's a function of time, advancements within the technology. And as one of your guests pointed out, that is accelerating. And the promise is absolutely there for AI to have a very meaningful impact on the R&D side and the data side on the R&D side as we think about that kind of medium to longer term. So I think it's just a function of time. And when we think about the time frame from a drug from going phase 1 to development, is typically on average around 11 years and over $1 billion of capital to get there. I guess one of the promises of AI could be that as opposed to a 10-year time frame, we could start to see that even shorten from just from data analytics in and of itself. So I guess the answer to that will be time and investment. And I think the investment is actually accelerating. So to see it speed up, is it going to be 5 years, 7 years, 10 years? I think it's going to happen regardless over time.
When I think of AI, I think of those pictures that you see online where people have like feet for hands and stuff. So when I think about it from that perspective, it makes me really nervous to think of healthcare and AI together. So I think you're right. The whole idea of moving forward, and as we continue to get better and better, as it has already in the short period of time we've had access to it, I'm sure that we'll feel more confident in having it more in our healthcare space. So, all right, we're gonna have to leave it there. Any final thoughts that you'd like to share with our viewers today, Paul?
Yeah, look, I think from a Canadian's perspective, this is healthcare is a great area to be looking at. You've really got to take a medium, longer term. Diversity is really important. We highlighted that. And so really appreciate the time to come on and be able to share some of our views and some of the great questions. And Caitlin, thank you again for having me on.
Yeah, it's been a pleasure. It's been great having you. Thanks again to everyone in our audience as well who has joined us. Make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. We do these sessions on a regular basis. We have lots of great guests just like Paul on a regular basis. So please tune in to those sessions. If any are of interest, register for them and we will see you then. We also have a survey that will pop up as you exit today's session. We'd love to have your feedback on today's session and know what you'd like to see in the future as far as these sessions go. Thank you so much, everyone. Please have a wonderful rest of your day, and we will see you all next time. Bye, everyone.
Have more questions? Check out the links to the right and in the description below.